end of the day, really what happens in 22 is we have to sit back and recognize that a lot of the growth expectations that we have for earnings are going to be trimmed, which means, 2022 will be a good year for stocks, but it's not going to be as good a year as 2021.
Hi, and welcome to Behind the Wall. I'm your host, Joanna Macris at Investor Place. And today we're back talking about the macro outlook, both for Q4 and our thoughts going into next year. Here to make sense of what's going on is Steve Ricchiuto, Chief Economist at Mizuho Securities. Hi, Steve, welcome.
Thank you, Joanna. Good morning.
Great. So let's get into your thoughts on Q4. Obviously, from a stock market perspective, we are seeing a sector rotation into stocks, more positively exposed to rising interest rates, abating fears on Omicron. What are your thoughts on Q4 and what the stocks are going to look like as we close out the year?
Yeah, that's a great question. Well, we upgraded our growth number for Q4 to 6% from 4%. We did it well before the payroll employment numbers. In fact, we did it on the backdrop of evidence that there was a early rush in holiday spending, and that will lift the fourth quarter average relative to the third quarter, which was depressed, again, due to a lack of consumer spending. So we think that early rush in spending, along with what turns out to be a fairly significant decline in the trade deficit in the month of October, suggests that we are going to have a nice pickup in economic activity to that 6% level. Our forecast for 2022, however, is that we are going to gradually slow down from this level. And by the end of next year, we'll be looking at growth rates of closer to 2 to 2.5% on average going forward. Our actual specific forecasts are for first quarter growth to be 4%, our second quarter growth to be 3%, our third quarter growth to be 2.5%, and our fourth quarter growth number for next year to be 2.25%.
So as we think about GDP growth, what do you think are the key catalysts for reacceleration next year?
Well, the deceleration that we're going to get in 2022 is a function of expectations of higher short-term rates, i.e. the Federal Reserve tightening monetary policy. The market's already doing a lot of that for them. That's why the yield curve has been flattening, or I should say the spread between 2-year Treasury notes and 10-year Treasury notes have been declining. That flatter curve environment then creates a less confident environment for corporations going forward. It also makes it harder for banks to make money in lending, and therefore they pull back on their lending. So it creates an environment of a slower GDP area. The stronger or I should say the rising short-term interest rate environment then creates a rising currency, and a rising currency then adds to the deceleration in growth next year. And on top of all this, if Joe Biden gets the stimulus program, the version of Build Back Better that is incorporated or has been passed through the House of Representatives and is currently stalled in the Senate, it will actually be a net negative on the economy because the spending levels on aggregate are not much different than those incorporated in the American Rescue Plan, which was his first piece of legislation that got done last March. But he will have higher taxes. So those tax increases will lead to a slower economy going forward into 2022.
One area that's been tricky to predict is the housing market, which you alluded to. What are your views looking into next year and impact on economic growth?
Well, housing is not going to be negatively affected by interest rates in 2022. You wonder whether or not rising prices leads to an environment where it reduces demand because people just simply get priced out of the marketplace. But I will warn you that there hasn't been this big rush to building new product and bringing it to market. And that, I think, will happen in 2022. And I think that will lift the economy as actual construction put in place, dollars spent in the economy actually go up on new construction as opposed to everyone running out and buying existing product.
Makes sense. Labor, another major concern across a number of industries. What's your view on the labor outlook and impact?
Well, everyone's talking about the strikes. Everyone's talking about the fact that, wages are going to go up in 2022 because of the scarcity of workers relative to jobs. I think a lot of the jobs that are currently counted as open will disappear. I think they're permanently gone. I think as people reset their business outlooks going into 2022, we will discover that we were holding on to a lot of jobs in our totals of openings that were pre-COVID. I don't think all those jobs are coming back. So I think, this job opening versus job hiring or hiring divergence that's been happening will basically correct itself from both ends in 2022 rather than being corrected all from one end. And therefore, I think it's going to be hard for labor to make back all of the reduction in their purchasing power that's come as a result of higher prices.
Mm. Supply chain, obviously, a number of companies are talking about those concerns abating. We did see a decline in the auto sector last quarter. What are your thoughts? And are there any particular sectors that you think are more immune to disruption?
Well, that's a great question. I wish I had a good answer for you. I will tell you what I've noticed from our inputs is that people or companies are finding alternative ways to avoid the bottlenecks. It's a little bit more expensive in many of these cases. You have to go to different ports. You have to truck product. You have to load it on trains, or you have to bring it in by air. All these factors are clearly weighing on the cost structure. But again, I don't think corporations are going to be able to pass all of this through to the consumer. And I think at the end of the day, really what happens in 22 is we have to sit back and recognize that a lot of the growth expectations that we have for earnings are going to be trimmed, which means, 2022 will be a good year for stocks, but it's not going to be as good a year as 2021.
Right. Oil prices, at what point do rising oil prices derail, potentially slow recovery for next year?
Yeah, oil prices and the nature of the economy. It's interesting. We were able to grow fine with $100 barrel oil. We have become much more efficient as an economy in dealing with the energy environment. I mean, an energy shortage, not just a price gain, would be a real problem. But we don't seem to have those. You have those concerns in other regions. You don't seem to have it here. Here, it's a function of price.
With all of these moving parts, what sectors do you think are really best positioned for 2022?
I really think the defensive positions, and I would put growth into a defensive position these days because growth has been behaving that way because, the reality is in an environment where you're looking for where the economy is going to do better, the transition that's going to continue to take place where we substitute capital for labor, it's really going to continue to benefit the growth sectors. And I think those are the areas that we will see continued value improvement next year. As the year progresses, I do think the yield curve will re-steepen somewhat as the market does most of the tightening for the Fed. The Fed will not have to validate all of it. And the net result will be a steeper yield curve and some improvement in banks later in the year. But that's really a second half story.
Companies are also sitting on a ton of cash, and we haven't seen much in the way of dividends and stock buybacks. Do you think that's going to change next year?
Well, clearly, that's one of the factors that I think leads to the equity market continuing to do well next year against the backdrop of what I think will be a squeezing margin environment, is companies will deploy that cash towards buybacks to hold up shareholder value, because that, after all, that's how CEOs are paid in this country.
Yeah. Lastly, Chinese stocks are on everyone's mind. Obviously the Chinese internet ADRs, the sell-off related to the DD listing, potential tightening from the SEC. What's your view on, investor appetite for these stocks?
Yeah, I mean, I think investors have been rotating out of them. I think they're looking at what's happening in China and they're concerned. They're beginning to come around to our view that China is heading to a much slower, sustainable growth trajectory, and therefore, with the government ratcheting in their controls of a lot of these products that were previously very high flyers, I think there's a rotation out of the market that I think will be permanent. I'm not saying people are completely walking away from it, but I think people have taken a good chunk of the money off the table in fear of what may or may not happen. And I think rightly so. Their problem has been, where do they go with it? And I think initially some of it went into crypto. I think some of it's come back into the US market over time. I think some of it will go back into other emerging economies as well. So I think that money will be redistributed throughout the markets.
And then lastly, if you had to think about how is investing different in 2022, what are some of the forces that could be tailwinds and headwinds, and just what does it look like relative to what we saw in 2021?
Yeah, I think in the first half of the year, it's all headwinds, which was different than what we saw in 2021, when a lot of it was tailwinds. In the first half of the year for next year, it's all headwinds. Then as the year progresses and we begin to recognize that the economy has slowed, the inflation numbers have come off the boil, wage numbers haven't gone up as much, the Fed isn't going to be forced to do as much. Look for the currency to reverse, look for the interest rates to reverse, look for the yield curve to steepen, and look for the equity market to be able to get beyond all the uncertainty and push back up towards higher levels as the year progresses.
What else are we missing in terms of the macro outlook? What else would you want to point out for retail investors?
Yeah, no, at this particular juncture, I think we've covered just about everything. I mean, I don't think energy is going to be a drag. I think fiscal policy will be a drag, but I don't think we've missed anything at this juncture.
Awesome. Steve, thank you so much for your time. Really appreciate your insights.
My pleasure, John.
Take care.
Thanks for watching Behind the Wall. Please like, subscribe, and comment, and check out our website, investorplace.com, for early access to videos and an even more in-depth look.